Chapter 10, Question 28. In this question, we have two questions. The first is, assuming the NGN is the subsidiary's functional currency, and what is the translation adjustment determined solely for 2017? Question 2, assuming the US dollar is the subsidiary's functional currency, then what is the remeasurement gain or loss determined solely for 2017? Okay, so let's look at the first question now. The first question is to assume that the foreign currency or the NGN is the subsidiary's functional currency, which means that we are going to use current rate method. And within this method, we assume this company's net assets are exposed to the exchange rate risk. A net asset here equals to total assets minus total liabilities, which means that for any transactions that involves any asset or liabilities that will be exposed to the foreign exchange rate risk. To solve this question, we kind of compare two numbers. One is what is going to be the ending balance of their net asset in foreign currency, and what is that amount in the US dollars if we keep update the balance based on the current exchange rate. Okay, so here I prepare a schedule to show you how we can solve it. And so on the first day of 2017, we have the beginning balance of net asset, which is 30 million NGN foreign currency, and on that date the exchange rate is 0.0064, and we use 30 million times the exchange rate. We can get the net asset in US dollars, which is 192,000. So basically what we're going to do is that we for each line we can use the second column, net asset in foreign currency, and times the third column, the exchange rate, and get the corresponding net asset in US dollars, which is the last column. Okay, so next let's have a look at those individual transactions to see how or whether they are going to impact the company's net assets or the total asset or total liabilities. So first transaction is the company paid 8 million NGN on notes payable. Okay, in that transaction, the journal entry is to debit notes payable and credit cash. So net impact on total asset is actually 0. So it's 0, then which means that we do not need to make any adjustment. Second transaction, they sold entire inventory for 60 million NGN. This transaction, there are going to be two journal entries. The first journal entry is to debit accounts receivable and credit sales by 16 million. So that's going to increase the total asset by 16 million. So that's accounts receivable, right? Receivable. And second journal entry is to debit cost of goods sold and credit inventory. That's going to be the cost of inventory, and the number is given is 10 million. Their inventory dollar amount is 10 million. So in this journal entry, we are going to reduce our asset by 10 million. So that's the inventory work. And the net amount in this transaction is going to increase our total assets by 6 million. So that's next amount of impact. Okay, so then we use 6 million NGN times the exchange rate on that date, on May 1st, and then the corresponding US dollar amount is 40,800. Next, and move on to June 1st. On June 1st, they sold land for 6 million NGN cash. On this journal entry, we are going to debit cash 6 million. So that's going to increase our cash by 6 million. And we are going to credit first, it's going to be the cost of land. On our book, we know that the cost of land is 4 million. So we credit land 4 million, and then we'll credit again gain on sale 2 million, but that's not either asset or liability, which ignore that. So net impact on our net asset is a positive 2 million NGN, and times the exchange rate on June 1st, which is 0.007, and then the corresponding US dollars for this transaction is $14,000. Okay, so that's on the June the 1st. Then on August 1st, they collect all accounts receivable. A journal entry is debit cash, credit accounts receivable, same amount, and net impact on the total asset is 0. September 1st, they signed long-term note to receive 80 million NGN, and journal entry is debit cash, credit, notes payable, and still the net impact on net asset is 0. And then October the 1st, bought inventory for 20 million NGN cash, and journal entry is debit inventory, credit cash, same amount. So still net impact on the transaction, on the total net asset is 0. November the 1st, they bought land for 3 million NGN on account, will be debit land credit accounts payable. Still the net impact on net asset is 0, because in the 4 transactions we're going to increase both asset and liability the same amount. Alright, so on December the 1st, they declare and paid 3 million NGN dividend. The journal entry will be debit dividend and credit cash. Okay, so in this transaction, we're going to reduce cash by 3 million. So net impact is going to decrease our net asset by 3 million, and the corresponding US dollars on that date is 24,600. And then on December 31st, they record depreciation for the entire year of 2 million. And journal entry is to debit depreciation expense and credit accumulated depreciation. Well, that accumulated depreciation is going to reduce the book value of the buildings, right? So then that's going to reduce our net asset. So this is going to be the negative amount on the buildings. And then times exchange rate on that date. So corresponding net asset in US dollars is $14,100. All right. So after we input all those numbers, what we can get is we can get 2 numbers. The first is if we do not convert all those foreign currencies to US dollars based on those transaction day exchange rate, then net million, the net assets ending balance will be 33 million. Right. However, if we transfer those transactions into US dollar, then ending balance would be $207,400 US dollars. Okay, so one more thing about this last transaction, the depreciation, the interest rate we used for depreciation is actually the average rate for the whole year, because we assume that that's going to evenly spread out the whole year, not exact days rate. Okay, anyway, come back to this table. So then if we convert this ending balance from the foreign currency to the US dollars based on December 31st, so this is the December 31st exchange rate, then the actual amount is going to be $277,200. So this number is more like what the ending balance should be in US dollars. However, $207,400 is what they have recorded on their book. And the adjustment here, adjustment amount is going to be a positive $69,800. Question B, if we assume the US dollar is the subsidiary's functional currency, then what is the remeasurement gain or loss determined solely for 2017? If US dollar is the functional currency, then we need to use temper method. If that's the case, then only the monetary position of the subsidiary company is exposed to exchange rate risk. And here, the monetary position include cash, marketable securities, and receivables, and the other assets are not included, such as inventory. Okay, so we're going to prepare a similar schedule like a prior question, and we have the dates, so we use those dates to check the transactions, and also we have the net asset in NGN, the foreign currency, we have the exchange rate, and we have the net asset in US dollars. And on January the 1st, so this is like the beginning balance of net asset in NGN, it equals to negative 4 million. So how we get negative 4 million? And we use 16 million. So this is the total amount of cash and minus the 20 million notes payable. Then give us a negative 4 million. Okay, so then that's like the beginning balance of NGN, a beginning balance of the net monetary position in foreign currency, and we can translate that into US dollars. By timing the January 1st exchange rate, we get negative $25,600. Okay, so let's have a look at those transactions one by one. February 1st, it paid $8 million NGN on notes payable. So in this transaction, we debit notes payable, credit cash. So net impact on the net monetary position is 0. And then second transaction, on May the 1st, the company sold entire inventory for 16 million NGN on account. First journal entry is to debit accounts receivable and credit sales. So that's going to increase our accounts receivable by 16 million, right? And second journal entry is to debit cost of goods sold credit inventory. Remember that inventory is not considered the net monetary position, so we ignore that journal entry. So the net impact on the net monetary position is 6 million, the accounts receivable, and times that the exchange rate on that date, the net asset equal to $108,800. Okay, then June the 1st, the company sold land for 6 million NGN. So journal entry debit cash, credit land, and let me put it down. So this is the accounts receivable, and then the 6 million is cash. The journal entry to debit cash and credit land. So because land is not net monetary, is not the net monetary position, so we just ignore the land, the negative 6 million. Instead, we only consider this increase of 6 million cash. So that equals to $42,000. And then August the 1st, collect all accounts receivable, debit cash, credit accounts receivable. Net impact is 0. September 1st, long-term note to receive cash, so debit cash, credit notes receivable, notes payable, that's still 0 net impact. Then October the 1st, they bought inventory for 20 million. The journal entry is to debit inventory and credit cash 20 million. So remember that because inventory is not considered net monetary position, so only consider this negative amount of cash of 20 million, and that equal to $156,000 based on that day's exchange rate. Okay, so November 1st, they bought land for 3 million on account. A journal entry is to debit land credit accounts payable. So this is going to increase our net monetary by negative 3 million. That's accounts payable because land is not considered the net monetary position. So that equals to $24,000. December 1st, declare paid dividend 3 million. Journal entry debit dividend credit cash. So that's a decrease of cash or decrease of net monetary position by 3 million. Alright, so so far we have input all the numbers that have impact on the company's net monetary position. So it's not actually net asset, it's net monetary position. And so the ending balance, if we use foreign currency, is going to equals to 8 million. And the 8 million, if we convert that to US dollars times the December 31st exchange rate, is equal to negative $67,200. However, if we update everything with US dollars, then the net the net negative position amount is negative $79,400. So as prior table we noted, this is the what number should be. Oh, sorry, this is a number. So negative 79,400 is what recorded on the book, and the 67,200, this is what the number should be. And if we use should be amount minus recorded amount, we get a positive 12,200. So this is actually a gain. That's a remeasurement gain.